Hello, I'm Michelle Makori. Thank you for joining us. A Fed rate cut in March is not looking likely. Fed Chair Jerome Powell says that the U.S. central bank will likely not be comfortable enough with the path of inflation by its next meeting in March to cut interest rates.
Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen.
Now, as expected, the Fed left its key policy rate unchanged at 5.25% to 5.5%. And Powell did say earlier in the news conference that rate cuts would likely begin at some point this year. Let's get some analysis on this and more with Dr. Nomi Prins. Nomi is an economist, a geopolitical and financial expert. She accurately predicted the 2008 housing crisis 2 years before it happened, and she also called the market meltdown in 2020. She's a best-selling author of Collusion: How Central Bankers Rigged the World, and her latest book is Permanent Distortion: How Financial Markets Abandoned the Real Economy Forever. And she's also the author of the monthly newsletter Distortion Report. Nomi, very good to have you with us. As we just touched on, the Fed leaving rates unchanged. Chair Powell did tell reporters during the Q&A part of the press conference that a March cut is not likely. He did, however, sound quite optimistic about the current economic environment, stating that the U.S. economy is expanding at what he called a solid pace, while the labor market is rebalancing, as he puts it. He also clarified that any rate cuts won't come until there's greater confidence that inflation is moving towards its 2% goal. So what are your thoughts from what we heard from the meeting, from the statement? What is your main takeaway here?
Yeah, so this is a very typical Powell trying to cover all bases. Rates, what's happening in inflation, what's happening in the economy, and what's happening in the jobs market. So basically reminding us all that the Fed has a dual mandate: price stability and employment stability. And that requires the labor market being a bit less hot than it has been, which he seems to be confident is happening, because he did not say he was not confident. But he said he was not confident necessarily that inflation would continue to abate at the levels that it has over the last 6 months, which means, and as he said, he wants to be more data dependent, data driven in terms of specifically watching out for inflation numbers. So that's the thing for us to watch now. He kind of took job numbers off the table. He kind of took the economy off the table. So it's still just come down to seeing data that shows from their perspective that inflation is continuing the path that it's already on. And hence, they need to spend more time and have more data come in. And that's one of the major reasons why there won't be a March cut. I not thought there would be a March cut. I do think it's going to be rate cuts towards the second half of the year. But in the Q&A, he did answer some questions that indicated to me there could be other ways of the Fed loosening monetary policy before the second half of the year.
And those other ways in the form of quantitative easing, reducing the quantitative tightening. What was your read on how he may create more liquidity while seemingly staying put on interest rates?
Yeah, and walking that really interesting tightrope. So what we've seen is, and he did say he's comfortable with the book, meaning that he's comfortable with the pace of quantitative tightening. Now, it's important to note that if you look at the H4.1 reports that come out weekly from the Fed, that quantitative tightening that is in play has actually been reduced. We didn't see that much this month compared to what their target bond roll-off has been. So QT is becoming much more QT light anyway. And then in a very interesting question, he was posed about whether there was a kind of distinction between the policy tool of rate cuts versus the policy tool of quantitative easing, or putting money into the economy, into liquidity for banks. He said those two tools could be separated. And he also said that that was going to be a specific topic of conversation for the March FOMC meeting. To me, that means we could see various forms of QE. For example, the Fed extending its bank term lending program, which it started last March when we had those 3 big bank failures, past its March 11th date, which is when it expires, to further further another year, further 6 months, or just further. We've seen some record takers from that lending program just in the last couple months since we had a major regional bank, Citizens Bank, fail in November, which almost nobody paid attention to. So again, I think he was indicating, without trying to, that there could be some movement towards some various forms of QE before we see actual rate cuts.
So in a way, Nomi, does that negate what they're ostensibly trying to do, right? We're looking big and bold and strong and sticking to our guns and keeping the pause on the rate cuts. And I mean, I think we can safely rule out any more interest rate hikes at this point, but like, no, we're not pivoting. But then at the same time, finding other ways to inject liquidity into the system. So it seems like the one effort negates the other. Or is there a way that helps with keeping sort of the banking system well afloat without necessarily impacting inflation? Is that an equation that's likely to work?
Well, it's interesting because this is exactly what we saw almost a year ago in March when we had those three big bank failures, Signature, Silicon Valley, and First Republic. The Fed turned around and basically opened a little bit more than $300 billion worth of money, effectively a backdoor QE to the banking system. It did increase the size of their book while they were still supposedly in a quantitative tightening mode. And yes, that's a different policy, but it is a loosening policy. It is a provision of liquidity to bank policy, even while Powell is really trying to have everyone just focus on inflation and now to a lesser extent the employment situation and the economy itself. So they do kind of negate each other, but what they mean together collectively is if there is a sort of step back from the current quantitative tightening policy into some sort of more quantitative easing policy before rates do get cut, it does mean that there is more liquidity in the market. That doesn't necessarily come into inflation because inflation does have other actors on it: supply chains, geopolitical disruptions,
right?
Oil tankers not being able to get through the Red Sea or whatever it might be. So one doesn't necessarily impact the other, but QE is inflationary from a monetary perspective. And he will not admit that or say that if they extend their lending program or if at the next FOMC meeting they determine to say stop or give us a schedule of stopping QT completely before rate cuts.
Right. And I definitely want to get into the other inflation factors that could come up, as you mentioned, on the geopolitical front, because I do know you have tremendous expertise in that area as well. But keeping it with the Fed for right now. So the market's slightly disappointed. There were expectations of a March pivot. What kind of market reaction do you expect then, purely from the equity market side of things, if the Fed holds steady on rates, whilst, as you say, finding other ways to get liquidity into the market? Does the equity market translate that as a pivot? How do you expect that to manifest itself in terms of the broader S&P?
Yeah, that's a great question because I think the commodities market understands QE a little bit better and the gold market than the equity market if it's detached from rate cuts. I mean, we had so much and have so much attention on rate hikes or the possibility or the timing of rate cuts over the last couple of years in all of the sort of media, that's kind of where a lot of the markets focus first on those interest rate adjustments. And so yesterday when, there wasn't an interest rate surprise to the cutting side, because I think it's a surprise. There was no indication to me last December that there was going to be a rate cut in March. I think the markets wanted it, didn't get it, but I don't actually think it was telegraphed. So that's one thing. And I think they're going to regroup and be fine because they're going to look past the March meeting to the summer now. And there's going to be volatility out there. There generally is before and around these FOMC meeting announcements. But I think overall, there is a lot of money on the sides. There is knowledge that there will be rate cuts when they come. And if we do see QE before that, I think the markets will look to translate that as just a step along the way. And that's positive for things like tech and sort of more of the types of sectors that require cheaper money, or at least are looking towards cheaper money. On the commodity side, on the gold side, I think it's more in tune with quantitative easing. If we do look at sort of where the Fed has been on quantitative easing versus where gold prices have reacted, they tend to react more positively to quantitative easing net of interest rate cuts, and then obviously more so to those, because those decrease the value of the dollar, and that increases the relative value of gold to the dollar. So it really depends on which part of the market we are looking at.
Right. And hence we drew the distinction there. Before we get back into gold, let's focus a little bit more on the equity market, because there's been concern of, a potential sell-off in the equity markets by many of the guests that have come on this show. Do you think that this sort of negates that concern? What is your read then in terms of what you expect the equity market response to be if this balance of, okay, we're going to hold off a little bit in March, but we are still going to create that liquidity through backing off on the quantitative tightening and some kind of form of quantitative easing? What does that mean for your outlook on the broader equity market?
Well, I think ultimately the equity market ends on a positive note, because ultimately over this year, we are going to see some form of QT, or at least backing off a QT. We are going to see rate cuts at some point later this year. So there will be a cheapening of the cost of money that will come into the markets that is good for particular technology sectors and the commodity sector. So this is going to happen just over time. What that means is, though, there's going to be a lot of volatility. Markets and market commentators tend to be very impatient about every single reaction to every single number that comes up, particularly, with the FOMC meeting announcement. So I think we're going to continue to see this sort of volatility surrounding the next few FOMC announcements. And what that ultimately means, for example, with respect to technology and those sectors that require more cheaper funding for their growth strategies and their development, that includes AI and, the entire tech sector, is that, the best strategy for dealing with all of this is to be patient. And what does that mean? It just means legging into positions in overall tech names. If you have $1,000 to invest, it's $250 at a quarter. If you have, and more in terms of what those investments could be, retail versus obviously institutional, the numbers go up. But basically, to divide out the outlook over time and sort of average into the upside, as opposed to trying to time it this year.
So bigger picture, are you overall bullish on the broader equity markets this year?
Yes, bigger picture over the year. I am bullish on equity, particularly in the technology, the energy, and the commodity sectors.
So you do not see this massive crash, this massive sell-off that many of the other guests on Kitco have been warning to expect this year? You see it going the other way? I don't see
a massive crash. I do see the potential for a massive crisis in the banking sector. I do not think that we are out of the woods there. But I think if that happens, it's going to be, as it has been, remedied by QE, and that's going to help these particular sectors in and of itself by creating liquidity in the sort of longer term debt sector. So for long term financing, which they require. So no, I don't see an overall market crash. I do see the potential for a bank crisis and crashes or bankruptcies or failures continuing in that sector. So it is, just to be clear, a sectoral kind of look that I have as well.
So there wouldn't be spillover from that? There wouldn't be contagion to the rest of the market if we start to see the reemergence of a banking crisis?
There will be contagion to the market, but again, that will be remedied, I think, by these open doors now to whatever type of QE tools can be utilized for that. And the market cares ultimately less nowadays about specific regional banks failing. Look, it's different if we have JP Morgan failing. I don't see that happening. But we've been able to sort of gloss over the sort of regional banks failing, including not even talking about Citizens, barely in the news last year, towards the end of the year, because it just didn't sort of rate. But it was a pretty major regional bank that failed. I think the markets can digest that with Fed help to the banking sector or the regional banks that remain standing. So they're kind of springboards for market going down, market going up, and that's why I mean. What I say before about looking at these investments this year as very much cumulative rather than trying to pick a point, because we will see this sort of volatility come in from a sector perspective and potential banking sector.
And as you mentioned in your book, the permanent distortion will continue as the Fed sort of steps in and keeps the banking system afloat. But that doesn't mean necessarily that you won't see that leading to a further increase in equity markets in this distorted system that we've now sort of found ourselves permanently in. Great book, by the way, Nomi. So what does that mean then for gold? Because the gold investor, typically a little bit more savvy than the equity investor in terms of looking at other macroeconomic trends, in terms of reading just beyond the headlines. So what does it mean for the gold investor that sees, okay, we do have more money coming into the system? Do you expect gold to react to that?
Yeah, I do. And I think gold investors, as you say, as we've discussed a lot, tend to be savvy about timing. In other words, not trying to time when gold is going to specifically rise by a certain amount in a certain, tiny fraction of time, but to look at all of the factors that we see coming together right now for giving gold prices a lift. And those include what we've been talking about, the ultimate reduction of rates and potential QE along the way, and potential bank crises along the way, which we have seen historically to be net positive for gold. Any of those have added between 10 to 20% in and of themselves to the price of gold around the time that they happen. We also have continued central bank buying, particularly led by China, as the desire for more geopolitical independence continues to filter through the BRICS countries. And now the BRICS countries include a number of other major oil producing countries like Saudi Arabia, who are also looking towards buying mines for gold and other commodities. So we see this trend towards finding and utilizing more gold in moving away from trading specifically with the dollar, at least diminishing that trading amongst those countries, and also just in general, sort of moving away from the strength, the supremacy of dollar-related policy in U.S. policy. So that's going to continue, and that we've seen add between 10 and 20% to gold prices over time. And also we have an election year. And what we've seen, and it's sort of been in tandem with banking crises since 2008, is that gold tends to rise and the dollar tends to fall in the year or two after a major election. And given that's the case, and in the last, since 2008, actually even before that, going back to 2000, we've seen gold be able to appreciate between 50 to 100%. Now, I'm not saying gold prices are going to go to 4,000, but over this sort of 2-year period with all of these factors coming into play, I think we can definitely see gold go to 2,400 this year to the dollar and possibly to 3,000 in this entire gold cycle over time. So what that means to a gold investor is to continue to average in. Don't try to pick the moment, because all these factors don't all happen at the same time that gold is going to spike, but continue to accumulate on a regular basis, because I believe we are in a gold bull cycle for all of these reasons.
Right. So gold potentially hitting 2,400, you're quite comfortable with that evaluation for what we can expect in 2024.
Right.
And that's assuming, Nomi, that everything just sort of plays out as we expected without any major geopolitical escalation. And that will be a pretty positive, considering how, precarious things are and how many tinderboxes are just waiting for further ignition around the world. And I do know that you are a geopolitical expert as well, which is why I want to get your thoughts on sort of the latest development in terms of the Middle East conflict escalation there, because obviously inflation could rise dramatically depending on how things play out. And we are waiting to see how the Biden administration responds to that attack by what is believed to be Iranian-backed forces on a base in Jordan, a drone strike. It's now come out that we know that those drones came from Iran. The Biden administration has said that President Biden has decided how he's going to retaliate. They haven't said how, which is probably a good thing. My opinion, they're probably talking a little bit too much about what they will and won't do, but that's just my opinion. And Tehran has warned that it would respond decisively to any attack on its territory or interests. So what are the scenarios that you anticipate playing out here?
Yeah, I mean, there's some definite ongoing potential tinderboxes in that area. And it wasn't simply what happened with Hamas invading Israel retaliating into Palestine. That this has just opened up what have been sort of simmering conflicts throughout that entire region, and the latest one that you're talking about is just one manifestation of that. I don't think the United States wants to have a full out war with Iran, and despite what Iran said, I don't think they actually want to have a full out war with the United States. But there have been a lot of attacks by Iranian financed organizations in the Red Sea and so forth that do disrupt and can continue to disrupt, particularly the movement of tankers and the movement of oil, et cetera, in that region, which leads to inflation and leads to higher prices and potential monetary policy reconsiderations. So I don't see the conflicts in that region at a point right now where we're going to all of a sudden have them cease. I don't think pure diplomacy is going to necessarily be effective here. I think it's necessary to use. And I think that's one of the reasons why the Biden administration hasn't come right out and said, we're going to retaliate and, sort of be very specific about more of a blunt form of attack. But I do think there will be targeted skirmishes along the way here, particularly as U.S. and allied individuals and ships continue to get attacked.
And Nomi, yet we're not seeing this reflected in oil nor in gold.
Well, exactly, and I think oil has to an extent also been tampered down because of some of the fears which I think are abating, that we're in an economic recession period throughout the world. So although if we were in a sort of aggressively growing economic environment, we might see that type of geopolitical actions create a specific acute and quick spike in oil prices. That's abated by concerns that maybe we're not globally out of the woods on a recession possibility. Now, I think a lot of the data that's coming out of China, a lot of their demand in general for shifting some of their energy policy and resources that they need is indicative of their economy kind of turning a corner, actually towards positive, even though still negative information coming in. The European Union has mentioned that they have sort of turned a corner on recession. We heard what Powell said yesterday about the United States. So I think that information has just not kind of seeped into the oil markets. And that's why we've had this sort of dampening factor on one side versus what would ordinarily cause a spike on the other. And of course, gold follows that among some of the other factors I was talking about as well, which is why we haven't seen a sort of spike in gold or a retraction in gold on either one of those two things.
If we hear news of some massive U.S. retaliation on Iranian targets, do you anticipate that leading to some spike in oil and gold on that news?
Yes, absolutely. If there is a decisive major military action in that region, which causes all sorts of other ancillary regional movements, especially related to the flow of resources, oil, ships, and so forth. Yeah, I absolutely do see oil prices spiking, forgetting about whether there's a recession or not in the economy. I also think economies will grow anyway. And that will also, again, connect into gold being, a part of that.
All right, Nomi, I'm going to pivot to another topic here. We're running a little tight on time, but can't let you go without getting your thoughts on an issue that you've been waving the red flag on since early days. And that is CBDC, central bank digital currencies. You were one of the first to highlight how a central bank digital currency has the potential to pose a huge threat to liberty and freedom. Now, for our viewers, generally speaking, a central bank digital currency is the digital form of a country's fiat currency. It's issued and regulated by a nation's monetary authority or central bank. It's programmable, so it can be modified to work or not work in certain transactions, and it allows authorities to monitor every single payment made and received, so obliterates financial privacy and anonymity. And I, for one, was quite encouraged that former President Trump has been taking the message on CBDCs on the campaign trail. Trump, who of course is also the current frontrunner in the Republican race, promised to ban the creation of a central bank digital currency when he was speaking at a campaign stop earlier this month. And he warned that CBDCs could pose an extremely dangerous threat to freedom and vowed to prevent them from being created should he become president again.
And tonight, I'm also making another promise to protect Americans from government tyranny. As your president, I will never allow the creation of a central bank digital currency. You know about that? Ooh. I didn't know you know so much. I'm New Hampshire, very smart people. Very current. You know what they're doing. Such a currency would give a federal government, our federal government, the absolute control over your money. They could take your money, you wouldn't even know it was gone. This would be a dangerous threat to freedom, and I will stop it from coming to America.
So what is your reaction, Nomi, to what we heard President Trump say there?
Well, there is certainly a real danger about central bank currencies being used to feed into people's privacies, to basically be programmable currencies that can use blockchain technology, or basically technology that allows for the accumulation of information over forever about individuals and about what they spend, where they spend it, and how they choose to conduct their lives relative to their financial lives. And I think that is a serious threat. I'm not comfortable with the Federal Reserve having full autonomy over what I do with my money, or control, or just even a peek. Now, the Federal Reserve is an institution that is generally not transparent about what they do. And they have not indicated in any of their studies about CBDCs, more than sort of lip service to, well, we understand their privacy concerns, how they would actually be transparent to us if a CBDC were issued and were something that we would all use with regard to our information. So all of that is very concerning. And it's one of the reasons why, even though there are a lot of countries that are in various stages, 194 countries are in various stages of looking at how they could bring a digital currency to market, including the Federal Reserve. We have Brazil that's announced that they're looking to launch theirs, major, B and BRICS country at the end of this year. And the Fed's looking at those things as test cases. So I am very concerned about what that means to privacy. I'm concerned based on what happened with the SEC, and basically the SEC getting hacked before they announced the acceptance of Bitcoin ETFs when they're supposed to be protecting the public from anything that could happen nefariously in markets. I'm also concerned about CBDCs having the potential to really invite cyber attacks, and that also hurts people's information. So there's all sorts of levels where I am concerned. And that said, there's an act that's right now being floated around Congress that's being championed by Majority Whip Tom Emmer. It's got, I think, 75 to 80 co-sponsors on it, which is in tandem to what Trump just said. It is an anti-CBD surveillance law. So there is something that's working on a companion basis in Congress. This is not stopping the research that's going on at the Fed with respect to converting or to watching for an appropriate time or system to provide CBDCs, even though they're saying that they will wait for Congress's approval. So there's just a lot of pieces to this puzzle that have yet to unfold. We have to be careful about.
In terms, though, very quickly, of it becoming a reality, Fed Chair Powell testified before the House Financial Services Committee last year that it is something that would need congressional approval. What do you think the process would be? Is it something that a president could veto? Is it something that could sort of sneak in through some other kind of executive act? A lot of the guests that we've spoken to say they're not going to tell you, hey, welcome to FedCoin. It's just going to surreptitiously work its way into the system, and then they're tracking you, and then it's programmable, and then it's linked into a social credit system. It doesn't all sort of get advertised all in one go. What do you think the likelihood then of a central bank digital currency in the U.S. becoming a reality?
I think for all the steps that you mentioned, and that I've written about, that there are going to be a number of years before CBDC is a reality in the United States for the consumer, for an individual, if that does in fact happen. And what happens first is that the Fed moves to sort of digital currency representations of the dollar. Take that to mean what it means, but it's basically a precursor to a CBDC, and that they use the Fed Now payment system that was launched a little bit early, but launched last summer, which also actually connects Fed accounts that are basically digitally connected to the entire banking system and most of the major corporations that are involved in that financial system throughout the country, or the 120 of them that are part of the pact that signed on to the initial FedNow usage. That's the platform, right? So that's the step that already happened. From that, you have digital connection to bank accounts. From that, banks have digital connection to a Fed account. From that, it's a slippery slope to moving from a digital representation of the dollar, i.e. just electronic movements back and forth, to a programmable representation of the dollar. And then you have the beginnings of a CBDC. And yes, that can take time, but it can also be done for, quote, technological reasons that don't seem like a CBDC until, they're upon us. And I think that's what Powell was talking about. He doesn't want to push it in that way and call it that. And yes, it requires some approval by Congress to officially create a CBDC. But all these steps along the way could amount to exactly the same thing if we're not careful.
Right. And we need to be aware. We need to be careful. We need to keep awareness of this issue. And you've done such a great job on that. So we'll have to bring you back to discuss this topic at length. I'm very passionate about making our viewers aware of the potential threat here. I do know that we're out of time, unfortunately. I'm getting a wrap cue from my producers. Otherwise, I'd go on. But thank you so much for joining us. Really appreciate it, Dr. Nomi Prins. Great to have you with us.
Thank you so much, Michelle.
Thank you. And as always, thank you for watching. From me, Michelle Makori, and the rest of the team here at Kitco, we'll see you next time. And if you are watching us on YouTube, make sure to subscribe.